The United States is in firm control of its reserve currency status. This according to a recent interview with Treasury Secretary Scott Besson.
Are we doing the things over the long term to ensure that the U.S. dollar remains the reserve currency of the world? And we are.
And indeed, Besson has good reason for saying this. As we'll see today, the US dollar has a lot going for it. Strong economic growth, still used in a majority of international transactions, and no viable alternative. Yet with the dollar off to its worst start since 1973, unsustainable deficits, and growing calls for a replacement, the US dollar days could indeed be numbered.
I don't want it.
So what I want to do today is go over Besson's arguments as to why he thinks the US dollar's primacy is not at risk, explore several counter-arguments from economists and journalists as to why the dollar's days could be numbered, and then discuss some implications. As we'll see today, the hegemony of the US dollar isn't going away anytime soon, though pressures are continuing to build. We will obviously continue to track how this plays out on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the Treasury Secretary. On to the Treasury Secretary's interview. As mentioned, Secretary Besson said that the United States is doing what it needs to do to maintain US dollar hegemony.
We are setting the stage for economic growth. We are constraining inflation. We are making the United States the best destination for global capital.
And to a certain extent, it's difficult to argue with any of that short term. The recently passed Big Beautiful Bill is widely expected to deliver short-term economic stimulus, already sending stocks to new highs. During the week of July 2nd, with the passage of that bill, U.S. equities saw their biggest monthly inflow pouring in from around the world since November of 2024. And world central bankers, despite the continuing weakness of the U.S. dollar, continues to think that it will be king for some time. A recent survey from UBS of world central bankers found that nearly half said it's possible that the US would undergo a soft default, restructuring its debt. But the interesting part is that even with half of central bankers thinking that the US could do a soft default, 80% still think it will maintain its reserve currency status. So if this survey is to be believed, the US could actually undergo a soft default, asking allies to convert existing debt to longer-term zero-coupon bonds and still remain the reserve currency. That's an awful lot of staying power. Go ask your bank what happens if you tell them you can't make the payments and see if they're still willing to deal with you. But it makes at least somewhat sense. The US dollar still accounts for over half of the foreign exchange reserves held by other central banks. Further, the USD still constitutes 54% of export invoicing, meaning companies bill in US dollars, and constitutes 88% of all foreign transactions, meaning goods and services across the globe are all exchanged, or 88% of them, via US dollars. And finally, even if the world wanted to change the global reserve currency, there aren't a lot of great options available. For one, a point that was made by Christopher Wallen in his new book, Inflated, it's not even clear that the European Union would even want the job, having consistently flagged the problems for exports in maintaining a strong currency.
For the last time, I don't want it.
Further, even if it did want the job, its bond markets are fragmented, constituting multiple different countries, and it's not nearly as big as the US Treasury market either. Meaning, if investors wanted to hold the reserve currency's debt, say to use as collateral, etc., there just isn't enough of it. And what is available is highly fragmented across multiple different countries. And the second possible contender, China's yuan, also has some major obstacles to becoming the world's reserve currency. First and foremost, China's capital controls, which have been called the albatross around the Chinese currency neck. China currently limits the amount of money that can flow in and out of the country, and as such, it would be extremely difficult to convince others to hold the yuan as the world's reserve currency. Investors have a tendency to demand that they're able to freely hold, use, and trade any currency.
Well, that's not going to happen.
Further, similar to the EU, there just isn't a whole lot of Chinese assets available, with foreigners currently holding about $1.3 trillion worth of China's assets, compared with $27 trillion worth of that of the US. And that lack of depth and availability makes it almost impossible for the yuan to serve as the world's reserve currency, as the world's central banks need large volumes of safe, liquid assets, a safe place to park their money, and settle trades. According to the IMF, a reserve currency needs to be deep, liquid, and have open financial markets. Financial markets need to be deep to provide enough assets denominated in the currency to satisfy the demand of foreign investors and central banks. And China just does not fit that bill as of yet.
You're not that guy, pal. Trust me. You're not that guy.
So at this point, Besson is indeed correct. The yuan is not a realistic contender to replace the USD.
They also have 1.4 billion people who want to get their money out of China.
So what about gold? It's up about 33% year over year, far outpacing competing currencies as the ultimate safe haven asset, with some already noting that the precious metal is in fact the new reserve currency. But there are quite a few problems with gold replacing the US dollar as the world's reserve. For one, it doesn't generate a yield, meaning unlike treasuries, there is no income from holding it. Second, as noted by the Bank for International Settlements, with the speed at which transactions occur in the modern global economy, shipping tons, hundreds and hundreds of tons back and forth just isn't realistic. Impractical at best, causing gridlock at worst. Third, and maybe most importantly, though governments will never admit it, gold can't be used in repo transactions. That means that widespread adoption would limit central banks' ability to implement monetary policy, which in actuality means that it would limit their ability to print money.
Heaven forbid.
So, in summary, for right now at least, the US has strong economic growth, it's used in the majority of the world's transactions, and there's really no viable alternative for the USD as of now. So what about the counter-arguments that the US dollar is on its way out? These tend to fall into three categories: developing alternatives, US debt, and the weaponization of the US dollar. First, the development of alternatives. As the US dollar continues to weaken, we are seeing more and more movements towards de-dollarization, with growing calls for Brics to develop its own currency. There are obviously political, fiscal, banking, and macroeconomic challenges to such a move, but they're definitely working on it. And the bloc is working on developing an alternative to the US-dominated SWIFT system.
It stops today. You got it?
Further, the USD doesn't necessarily need to be replaced by a single reserve currency. We could see the emergence of a multipolar reserve currency system, a system currently being pushed by China. This would see the emergence of the use of multiple different currencies throughout the global economy. And the second problem, of course, as we're all well aware, is US debt, now sitting at $37 trillion, with the United States running emergency level deficits during peacetime, and the new big beautiful bill adding $3 trillion to the US deficit over the next 10 years. The inability of the United States to get its fiscal house in order is obviously troublesome to many investors, as it increases the potential that the US will try to either A, restructure its debt, or B, print its way out of it via inflation, both of which would result in a loss of return for those who lend it money.
Guys, the thing is, we totally have the money.
And we can see this on the yields on the 10 and 30-year Treasury, which have been moving ever upward over the past year, despite multiple rate cuts coming from the Federal Reserve. And finally, we have the weaponization of the dollar, which will inevitably and is now hastening countries' efforts to diversify away from it. From sanctions on Russia, president's threats against those who attempt to de-dollarize, you know this is just going to backfire. No country ever in the history of the world has been able to effectively dictate to other countries with impunity forever. And we can see this already with Brics and China redoubling their efforts at creating an alternative currency. So yes, right now Secretary Besson is correct. The US is not at risk of losing its reserve status. But these risks are growing. Countries are working on developing alternatives to the USD. There is no end in sight to the growth of US debt, and the continual weaponization of the US dollar isn't doing it any favors. As to how this is actually going to all play out, I think it's going to be slow. I think this is going to be a long, drawn-out process. No one actually knows where the end point is, what exactly would replace the USD. But as the USD does get weaker and weaker, and the other countries get stronger and stronger, or their will to challenge the United States gets stronger and stronger, which I think is obviously quite more likely over the next couple of years, the USD may in fact lose some of its grip. With that said, how all of this plays out remains to be seen, but we will obviously continue to track the US dollar on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.